All right, so you've been banging the drum here for folks to be very, very careful. There are still a lot of folks that are expecting this dip to get bought into September.
What do you mean a lot? Everybody.
Everybody, okay. Option positioning. And I had a big pre-market rant for clients. I did a big a big post for clients going, okay, I know the option positioning for September OPEX and the election and year end and seasonality. And even the Nomura chart that's going around that if we start September weak, like we have, then we finish strong. I got all of that. But here is what I want you to consider. The 30 year is going to drop into that 5 handle pretty quickly, and that's going to pull the 10-year down dramatically.
Were you saying that the 5-year is leading and it's going to drive rates down? Yes. It's going to stretch out as refi picks up. But the Fed is going to try to go only 25 on September 18th. That's what they want to do because they don't want the yields to go down because then stocks will collapse. Because mortgages are short option products, short volatility products, and if mortgages go up, it's going to get people to have to get long volatility, and they're going to have to dump their stock.
So why do you think they won't go for the 50 given if we continue to sell down into the 18th? I would
because
think
in the stock it would hurt the stock market worse.
okay.
The shorts in bonds and notes and 5-year, do they really want to have people buying them on leverage with less funding costs? If they go 50, it's just going to move the forward curve to a 2% in next year. And then you can just fund your bond purchases and your note purchases with a 2% funding cost using the red pack or the green pack. I mean, you could, they'll use derivatives and they'll just build up leverage, and then you'll accelerate refi, and refi acceleration is just a self-fulfilling nonsense that just drives rates to ZIRP faster. They bankrupt the banks faster. Look at Citigroup. It's a freaking disaster.
Oh,
They're
no.
sitting on.
Yeah, the fact that, and I'm one who is, I told this to clients and they know this repeatedly. I say, do not short all-time highs and do not buy all-time lows. But I have to tell you, as of 2 days ago, and I said this to them on Tuesday, and then Wednesday, I'm like, and then Thursday, banks rolled over and insurers rolled over. I said, I actually think this is a great short. So
they weren't at an all-time high. You waited for the algos to push it down to the 10-yard line, and now there's 90 yards left in the field. But you didn't do it out of the end zone. You waited.
Yes, and it is absolutely confirming today. But my point is, you are right that this is pulling down the strong sectors, right? So whether it be the utilities, staples, healthcare, and now obviously insurers and banking. But the point is, they are all seeing profit taking at the same time that the FANG stocks, etc., are also in continued, deceleration.
They're accelerating. They're accelerating.
Exactly. So where does money go? And some of the strongest trends that I have been in for clients for the past few years, like even medical distribution, if you take a look at MCK, just as an example, they are starting to really go under. But the point is, they've just wiped out all gains since February. So it's even happening in the very long and strong sectors. So my point is, there's distribution that's coming in also into everything. Exactly.
So when you call distribution, you could also call equity decay.
I call it kind of liquidity deflation. So equity decay.
Liquidity deflation is better than distribution because it manifests the view that something is falling. Distribution doesn't even mean anything to people. Liquidity deflation is it introduces the word deflation to people's brains early.
Yes,
but it also says that we're and then what happens when the dollar actually goes up?
Yes. So what I call distribution, clients know, because we're obviously in an accumulation stage or we're in distribution before.
But when people are nervous and you can get one word into their brain, the word deflation, liquidity,
correct.
Those are the ones that just viscerally attack them, other than this anodyne accumulation distribution, which happens all the time. You're bringing out a new phrasing which alarms them into action.
So this however, depends on the time frame, right? Like I know you have referred to semis in a big head and shoulder on a weekly. I've been talking about this for months as it was about to
No, I mean,
form.
I'm
That's called
highlighting the way
distribution.
people, I'm
Yeah,
highlighting the way you people look at it. You
yeah.
know, that you started the right-hand turn from the channel banked 90 degrees to the right. That's what a head and shoulders is, a 90-degree rotation of a healthy channel, right? Because
So
the right shoulder would have either gone to a new high and maintained the channel, it would double top and have a 45-degree shift, or it does a 90-degree, which just goes right to head and shoulders. But
so
it's other things going on. These
we
things are commodities. What?
yes, we have the same view. The only difference is that on a bigger picture, what I call distribution is it has the buyers are stepping away. It doesn't mean that sellers have come in to hit.
I no that is what distribution is. You have
Okay,
the hedge funds that are looking to get short. So let's say Nvidia, they dumped their Nvidia in the fourth in 2Q, and the reason they did it, and you could see it on the June 18th peak before everything else, because they need to get short Nvidia. Because when an institution wants to dump 1 million shares of Nvidia, these guys have to be short the million to be able to take it in.
correct. So
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 that
now,
yeah.
no, so now that we clear, as I have my own terminology, I'm again learning yours and your definition thereof. But now that we clearly see, the market clearly sees we're post distribution.
No, people who are looking, see, you're
Okay.
looking.
Yes, I am
Nobody's
always
looking.
looking.
Nobody's looking.
I
Nobody's
love
looking.
to see how the market dynamics play out between, it's a lawyering the trade is what I call it.
Go on
Look at both of it.
CLSD, and they're saying it's a great buying opportunity.
I know.
It's a great selling opportunity.
So here's the thing. Monday, I wrote this, I said this to clients and I wrote this as I'm going to write this next for clients because I just closed the room. I said, bulls need to hope that we gap down on Monday and that dip gets bought. That's the best scenario I can have for a stabilization
Okay.
and grind higher into the September 20 OPEX.
So the thing is, the system is failing. And I don't know if they're going to get lucky or smart and what their agenda is. And it doesn't matter. If they really make us clear that they're not going to cut 50, the market will stabilize.
If they
If they
make
go,
it clear they won't cut, is that what you said?
if they make it clear it's only 25, the market will stabilize.
Really? Okay.
Because they got to stop the bonds from rallying. They got to stop the notes from rallying. They got to stop people from losing money being short these treasuries and mortgages. It's not going to last for any
Yeah.
length of time.
Yeah.
But they want to get through OPEX. So, but I don't know if they know what they're doing. I'm saying what would work.
Yeah.
I'm not saying they get it. I don't know. I don't know what they know. I don't know what they don't know. I know they hired Beth Hammock, which my partner knew well, but this lady, although she's very talented, knows nothing beyond 1 year. She's a treasury lady. She's
Okay.
not a mortgage lady. They
But
need
they've
a
already
mortgage
lost,
person.
but they've lost the plot here with the 10-year coming back down and through the August 5th low. And by the way, I know you
Not
probably
intraday. Not intraday. It stopped at the intraday. It was 366 intraday. It beat the close, but it's still stuck on the intraday.
no, I
And
can see right
they don't want it to go through. They don't want to catch the stops.
here.
That's why they don't
Exactly.
want to go 50.
Okay, so I understand now what you're saying. So what I'm telegraphing is the 50 because the market is selling off and they'll want to play a little catch up. But you're saying they can't do a 50 because that is going to that will not stop the 10-year the
That
note.
will cause the mortgage to go up. And we were at 635 yesterday.
Yep.
Okay, we're going down today because they only knocked it down 3, even though stuff was down even more. Okay, they
Mm-hmm.
do not want this short mortgage. Excuse me, they do not want this short vol. These people are short mortgages like crazy. Okay,
Yep.
they're pairing off one option against another. They don't even know what kind of risk they're taking. So you got people short mortgages, and then they go up in price. And the Fed says, "Oh, we're not going to buy any mortgages. Don't worry. We're going 420 billion roll off. We'll go to 720." Don't think of us as a customer for mortgages. Well, you know what? The system likes it. And rates are coming down. And when they come down, you put all that duration on the front end and it gets stretched out. So we talked about the 5-year, 7-year. We were at +2. Now we're at +9, but we're at +2. And +2 is flat because the cash of the 7 is got a lag to the futures. But when the problem is when you get the 5 under the 7, when 7 is leading, going from 7 to 10, because 10's got futures, that moves much faster. And that's going to bring mortgage. There's no supply of mortgages. I've sent you the histogram showing that there's less than 2%
Oh
at
yeah, I
every
have that. Yep.
at every eighth of a point. There's no supply.
Yep.
You can go all the way down to 4%. Look how fast we went from the 5.5 to the 5. We were trading at 101.25 this morning. We're ready to go to the 4.5.
Wait a
There's
minute.
no
Wait,
supply.
are you talking about the 30-year going to what? You
No,
missed
the
up.
mortgage-backed security, current coupon, which is what they
Oh,
base
okay.
mortgages on.
Okay.
We rolled from a 5.5 down to a 5% coupon. When you
Okay.
go to 101, they then roll over to the next one, which trades at 99. We just went from 99 on the 5% coupon to 100.25. When we get to 101, they're going to start doing the 4.5. I mean,
I
we're
got it.
cutting through
Okay.
these things like a hot knife through butter, and then all you're going to do is lower these rates. What do you think's going to happen when people are start advertising 5.99 mortgages with 2 points? People are going to jump on that. But you know what? When they do 5.99 with no points, they're going to
Yes.
lose their minds.
So the question
But
is,
when mortgages go up, they squeeze they squeeze the shorts, and then you've got to liquidate or get liquidated, and you're buying volatility to close out your position. So we're getting the Volmageddon of Volmageddons. Selling stock neutral. When you sell stock, you're bidding up volatility, because when you're in stock, you're short volatility.
yes, yes.
And as the stock market goes down faster, vol's going to get bid and bid and bid. And then you're going to get institutions dumping because they don't need the paper under higher volatility. And then they're already filling up the balance sheets of retail investors. They don't have any more room. We're going to have 5% down days in this nonsense.
Yes. So all of this destabilization in the market has been occurring with
It hasn't started. It really hasn't started.
no,
Let's be
it
fair.
has been occurring since the
It
mid
hasn't started. We
July.
didn't have we didn't have we had one day that they bailed them out. August 5th, we were down
Yes.
6. We would have
And
been down
this
10. We would
Tuesday.
have been down 10 if they would have cut.
This Tuesday was also much more pronounced in VIX, like they lost the script, and we don't have a lot of VIX sellers
No, because
right
we're
now.
widening the channel. We're
Correct.
losing liquidity and
Yep.
we're losing people's ability to short volatility. Then you get that retail investor data point, the VIX VVIX crossover. Okay, Kate Leeds from Fairchild Securities, whatever her name is. She's kind of pretty good, except she's sometimes so late to the party. Like she didn't want to buy Bitcoin until after it already had cleared 25 from 15. Okay. But her work, she says volatility is rising because the wave can't, you know how you have AirPods? Do you have AirPods?
Yes, not on, but yes.
Okay. So you can hear the person, but you don't hear the car around the corner, right?
Yep.
That's because they have noise cancellation technology. So it's sending a signal to the speaker in the AirPod, but it's receiving information from the radiant noise. And whatever that wave is, whatever that sound wave is, it produces an exact mirror image and it completely neutralizes it. It cancels it. That's how deflation, that's how diversification works. You take 7 different companies with different wave functions, different sectors, and you superimpose one wave over another, and it neutralizes. If you would do a chart for all 7 of the malignant 7, and then FNGS, which is the fusion of that, you'd see one is moving up nearly in a smooth line, and the other ones are very fuzzy because it's canceling each other. Well, the Fed was doing that by jacking up the move and jacking up mortgage rates and diverting all the money into tech and smothering the distribution, getting rid of the tails on tech. They got rid of the put tail. They just got people to just short puts. They got rid of the tail. Oil. The Saudi got rid of the oil put tail. The Fed got rid of the treasury call tail. Those tails are coming back. They're coming back because that's the system, because
How,
policymakers are clowns.
how important is oil falling as a collateral trade, as a carry trade?
It's the biggest one out there. There's a lot of dollars involved. Have you seen the chart I sent showing oil's 2.1 trillion and gold's like 180 billion? I mean,
Oh yeah, of course.
oil is bigger than every other non-ag commodity combined.
Yeah.
And it was the last man standing, and the OPEC put us over. Kamala Harris screwed them. She said, I'm pro fracking. She said, I want to win and I want to get reelected. And if I've got to throw my ESG people under the bus, they're voting for me anyway. So she's all in.
Yeah.
Saudi cut prices over the weekend to Asia. Now they changed their mind because it fell 10% so fast and they didn't want to get some Momo. But you think oil isn't going down? You're the technician. You look at the chart. You don't go up.
I have already been on this strongly since April. So I
But it's
am very
policy. You had to wait for the
no, with my technicals to say that as soon as we break 70, we're going to go break a critical level of 65 that brings us down into an air pocket of risk all the way down to 40. So
because you have cohesion, which always fails at OPEC under pressure. It is never not failed. OPEC has never not failed under declining demand. They cannot shut in production and preserve cohesion. That's never worked. Iraq is cheating. Even Russia's trying to comply right now. But it's not going to happen. Nigeria, are you kidding me? Libya was their gift, didn't work. The issue is it's the big dog in the commodity space. We've already lost. You already lost copper. You lost aluminum. You got the food sitting down at 5-year lows. What are you going to sell? When oil goes down, that's a lot of performance loss. And the long only guys that a lot of pensions have to have, because they're long only, they're going to get the redemption call. There's no gate on that stuff because it's all liquid. It's not like PE leverage garbage. It's liquid. There's no gate on CTAs that are long only. There's only the gates on the short stuff sometimes. But the long, so it goes down. It smothers equity. It's what you just called it, liquidity deflation. But it's not. It's like the difference between Microsoft falling 10% and Spotify or Netflix falling 10%.
yeah,
Which one hurts more?
Of course. So you have made,
but it was policy. It was policy, and that was because when the Fed says data dependent, they're deferring some of their policy to OPEC, who takes supply off an inelastic product. They raise it, and then you have higher interest rates, right? And then the higher interest rates means more lending, more consumption. But whoever blinks first, the whole thing collapses, because lower oil means lower interest rates, lower lending, lower consumption,
lower GDP. So what about your call though? It's funny, by the way, now that the 10-year has broken and the 4.2, the 4, the 3.8, and obviously testing the 3.66 from August, I see a lot of folks saying that's fine. It's bullish.
Oh,
and
yeah.
Landing. And everything's we're going to be.
We're going to get a soft landing until we have a hard landing, until we have a very hard landing.
But
look, when you jump out of a plane, the old joke about some arrogant professor and like 3 other people, and they're all there's only 3 parachutes, and the young person said, no, you jump out, you have a whole life, so you take the parachute. And then the arrogant person says, well, I can cure cancer, so I'm a genius. So I need a parachute. So he grabs a parachute. And then the Boy Scout is talking to the old man, and the old man says, you're a youngster. You take the parachute. I don't mind going down on the plane. I had a great life. And the Boy Scout says to the old guy, don't worry. You know that guy who said he's a genius? He took my scout pack, not the parachute. You're fine when you jump out of a plane till the last 5 feet.
About the 10-year. That's funny, by the way.
What happens when we take out 366?
Yes,
you get 340, 350. And then what you're doing is you're bringing in which already takes out the KRE low, the Silicon Valley Bank low.
Yep.
And then you got 326. What's below 326? The 252 from
Yep.
the original Fugazi on
Yep.
August 2nd at 2 a.m. when Powell starts his nonsense and he doubles rates.
Yep.
Every basis point above 252 is cotton candy. It's not real. It's policy. It's not system. There's no real demand there. There's no demand for money. And then the only demand was mortgage. What?
Well, you said every basis point above 252 is cotton
From
candy.
252 to 407, it was all fake. The stock market has to go to 22 low. It wasn't real. It wasn't demand for money causing consumption. It was policy creating people who were making money in the slipstream of them pushing down treasury prices. And they got trapped in there. When we get to 252 and we go below it and the refi wave really explodes with 200% year over year refi, that's when you're going to have the bond inverted. That's when spreads will blow out like Queens Boulevard.
Okay, so that's when you have the inversion again, lower
The
to
full inversion. And that's why you've got to watch 5/7s, then 7/10s can be faster. But then you go 10/30 when the 30 is the low. That means volatility in the treasury market's blowing up. Excuse me. Skew is going to expand.
when
And
the
that's going
30
to
year is the low. Is that what you said?
when the 30 years the low yield on the curve, that's when you start to get skew rising in the bond. And that's price discovery. That's you go to zero, or the Fed has to cut non-linearly, which only has the effect of slowing the return to zero. We were at zero rates, and a bunch of idiots did some stupid things, and then they took rates up, but we were at zero rates. So we're going to go back to zero rates because the clowns took the rates up, not the system.
And now the system is taking rates down.
And they're allowing the liquidity to build up like drunken sailors. There's 325 trillion of debt producing 15 trillion a year, 1 trillion a month, and it's not going to buy FANG. It's going to be buying bills, then it's going to be buying maybe some notes, but it pushes the whole thing out. And we're losing trillions of dollars of expected note supply. When Powell goes to zero, that's $5 trillion of interest expense not there. When Powell goes to zero and mortgages refi, that's $6 trillion of expected duration, 6 trillion 10-year note equivalent. You're going to lose $10 trillion of supply in an instant. Citadel, in my opinion, if they're still in the trade, they lose 5 billion. Them in Millennium on this basis trade. They can't clean it up. The Fed's going to have to go to zero, and they're going to have to print. Volatility will explode. Then they'll print to smother volatility. Deflation will start evaporating, and then you've got the fusion of reflation and liquidity, and then you get the biggest bull market that ever existed in 1,000 or 2,000 days. But right now is the time to make small hits, to not make any big mistakes, build your nest egg,
So
beat the S&P, and get
question.
ready from getting the Facebooks, the Googles,
Yeah.
and the Teslas of the next wave.
Yeah, timing, the timing and rotation, that's absolutely my focus. But the translation of something you said regarding interest expense, 5 trillion in this interest expense that the government basically is, you didn't see it as a detriment, you see it as a positive, right? This liquidity that they're getting.
No, so what I'm saying right now is they're printing $5 trillion of more in the market believes there's $5 trillion more deficit of debt. So right now we're at 35 trillion. Okay.
Yep.
We're going to add 5 trillion from the primary deficit. They think we're not going 35 to 40. They think we're going 35 to 45.
Yep.
Okay. We're not going to 45. We're going to only 40. Because when they take rates to zero, your T-bill is going to go from 500 billion of T-bill funding to zero T-bill funding. And Warren Buffett's not going to be at the auction when he's dead. The new guy's going to be at the auction, and he's going to say, I'm not putting 300 billion at 10 basis points. I'm going to buy some stuff. Warren Buffett is dumping his stock because he's
Yes,
got
yes,
to
I
get
see.
everything under 10%
Yeah.
so that the other guy doesn't come in and sell and report 2 days later and everyone crowds him out to get out of the stock. He needs to get it where they at least can get out in 91 days. So they got to go below 10%.
Wow.
Or five, so they don't have to do even 13D. So, but you know,
And then the 6 trillion that you talked about in
so
refi
right now you
duration
have
that
a nine,
evaporates.
let's say
Mhm.
a 9-year average rate, 9-year average life of a mortgage. Okay. Let's call it 8 to make it easier. And then let's say we have 12.5 trillion of mortgage debt instead of 13. So that's 100 trillion duration years. So you have eight uh 8 duration years times 12.5 trillion equals 100 trillion duration years. You divide that um by 10 years, 10-year notes, and you get 10 trillion dollars of 10-year note equivalent services the entire mortgage universe. And we're going to lose half of the duration. So you're losing, or you could look at it a different way. We're going to go from a 9-year down to a 4-year average life. So that's 5 years times 13 trillion. That's 65 trillion duration years that evaporate. And that's the equivalent of 6.5 trillion 10-year note futures. So
Okay.
you're going to lose $10 trillion that people think are out there that are going to protect them from their short squeeze. It's going to evaporate. And
Okay, so
it's
that's
going to,
really the whole basis of the basis trade right there as well.
well, it's part of it. It's that, but it's also not just the basis people. It's everyone that's short. There are people that short to buy FANG. Some people short 10-year note futures to buy 10-year notes. That's the basis trade. But you
Yep,
have greeny asses who short the 10-year notes to buy FANG because it was going
correct.
up 100% a year.
And the same thing with the yen carry trade. But how is the oil component of this?
Oil is in the long is where is oil in the long basket or the short basket? Are
Oh,
people
definitely
buying oil or they're funding in oil? What? It's
they're
in the long
funding,
basket.
they're funding and they're buying in oil.
So they're funding it with mortgages and they're buying the oil, right? Oil's in the long account. Oil is sitting there with FANG, with crypto.
But my point
Uh,
is, how does this unwind since it's
you
such
just
a
you
huge
just said you just said that when a price goes down, it's liquidity
deflation?
deflation.
Mm-hmm.
So an asset that's long is liquidity deflation. An asset that you're short that goes down is liquidity inflation. So oil is held long. So when it goes down, it produces liquidity deflation. You lose equity and you force more liquidations of your leverage. You go from 4 turns to 3.5 to 3 turns. So when oil falls and you're long, are you losing money?
Of course.
So that's liquidity deflation.
All
Oil
right.
is held long. Oil is held long
I
because it
agree
was
with you. I'm
all.
not disagreeing with you. I totally agree with you. I'm just saying I wanted to understand how this is the next kind of shoe to drop. We've seen
No,
the
but it's a worse problem.
advancing
It's the worst
treasuries.
problem. It's a
Exactly.
worse.
That's my point. We've seen the yen advance since very strongly
No,
since
but there's an extra
July.
problem. There's an extra problem with oil
We've seen treasuries
because the
on since May, but we haven't seen oil drop. That's what I'm saying.
why? Because it's a policy out of OPEC. They're sitting on 5.8 million barrels a day, 2 billion barrels a year. Saudi has been doing voluntary after voluntary after voluntary cuts. And they were always going to pivot like they did in Reagan's second term and like in Bush's second term. You remember Bush's second term, July of 2008, 147 down to 32. Reagan was 25 down to 8. 7 months. Goodbye. What happened to inflation? 5.6 in June of 2008, 5.4 July of 2008, minus 2.1 in July of 2009, minus 770 basis points in 13 months. That's the problem with oil. If you're data dependent and oil goes down, then real rates are going to go up as Saudi pivots. And you blow apart credit spreads. Oh, look at Super Micro, 384 down from 1200. When
Oh,
someone
I know this is beautiful because literally 357, which we're almost there, it wipes out all of 2024 gains and it deserves it.
But what happened was it never was really 1,200. It was 1,200 because they did a $2 billion convertible note, which has a lot of embedded short volatility. And so those volatility positions don't show up on the dealer books for the open interest on options. So when it was going up, guys are getting shorter and they just buy. So that's why it squeezed up as they went through the S&P inclusion because of their convertible debt. It's a two-way street.
So wait
Then
a
you
minute,
excel.
you're talking about something that I don't understand when you're talking about the convertible debt. I can tell you that before Tesla got the inclusion, before SMCA got the inclusion, it was very clear that there were more calls being aggressively accumulated, more puts being aggressively sold, and those calls that were sold were getting called away as price moved into the higher strikes, forcing the dealers to cover by buying more stock. So it
Okay,
was
so let me ask you a question.
I could know what I'm saying is I could see that happening with
Okay,
Tesla.
okay,
I
but
could
this is my
see that
point.
happening with NVIDIA. I could see that happening with SMCI. But you're saying it's
Okay,
because of convertible
it's
notes?
worse. So let me explain. Okay, what you said, it's worse. What you said is exactly right. Okay, what you said about Tesla, what you said about NVIDIA, what you said about SMCI, but SMCI has some non-transparent options that don't get reported to the dealer. So people didn't even realize how long the call position was and how short the put position was. That's all I'm saying. When you have a
Interesting.
convert,
Okay.
there's an embedded option that doesn't get reported on the exchanges.
So,
And
okay, how do we know this? Like, how do we know
that's what a convert is. You have
but
the
how do
right
we
to
know
convert.
this? How can we track this? Again, remember, I'm
Wait. Did
retail.
they
I'm not.
issue a convert? Yes. Is a convert automatically something that converts into stock? Yes. So that is an option. It just doesn't get reported. So when you have a volatile stock and they do a convert, whatever you do, amp it up because because it's not reported the actual open interest of the call long or the actual open interest of the put short. You don't have to report over the counter derivatives.
Okay, this is something I'm not tracking. So this
Whenever
is
you
okay.
can't track it,
I
there's no
oh
no,
my
but you don't track it in terms of you can look at a data source. You have to impute it from the fact that it's a convert. And the
okay.
higher the stock, the more they get short and the more they got to buy. So let's say just that there's a million share net to buy because of the call the short call, the long call and the short put, and then you go the S&P inclusion and then bing bang boom.
Okay.
You can't say it's a million anymore. You got to say it's 1.25 million because there's 250,000 embedded in the convert. So you just have to amp up whatever you were thinking. And that's why it goes further. And
I didn't
that's
mean to
why
get off.
SMCI had the greatest RSI of any company in history because they had all the things you were watching. And then they had added options that people didn't realize from the convert.
Okay. So this is, but thank you for that because I know I'm going off track here. I'm talking about dollar and I haven't even talked about dollar. I'm talking about yields and
It's
oil.
all the same thing to me. You know that. It's all
I
the same
know,
thing.
I
They're
know. But
all risklets. They're all widgets. All risk gets diffused across all assets simultaneously by algorithms, and everyone thinks they're sitting all alone in a room, and that they can get out of the room when someone calls fire, and they're all trying to find the last musical chair.
yeah,
It's
it
all the
literally.
same thing.
Oh my God, that's so funny. I actually part of my my write-up for clients was a subheading that said
When
musical
music is
chairs.
about to stop and they're pulling away 5
No, it
chairs.
literally said musical chairs. And it was basically I review, hundreds of it doesn't matter what I said, but the point is this is why we're talking is because this inflection point, for lack of a better word. I know you've talked about and
But they're not pulling away 1 chair. That's the problem. They're pulling away 2, then they're pulling away 3, then they're pulling away 4, or they may go pulling away 1, 2, 4, 8. We don't even know.
I
That's
know
the problem.
this is why I wanted to talk to you because obviously I have only been like I have been right, but for the wrong reasons. And I think you
I
said
had somebody call out and said, I'm a Russian plant because he said, what do I think? Where's the market going? I said, well, if it went down 83.5% in 30 months, and we're in a worse situation now, I'd say we go down 90 in NASDAQ in less time. and he called me a Russian plan. So
I know,
I blocked him.
they're not serious. They're not serious thinkers.
No, it's just one guy. No, but a lot of people are very respectful. I just blocked him. I don't need that. But
I know.
the problem is, I don't know if they have any tools. They could try to delay, but I don't think they have any tools. We've never had this level. They invented new things this time. The quantitative tightening and the euro being where it is and the stock and the dollar being down. I mean, if the dollar was up, where would be the NASDAQ?
Now, hold on. We haven't even talked about the dollar, but just real quick. You love your analogs, but some people just play chopsticks on the piano. Some can actually, do a simple melody from the Beatles because it's really simple. Others, they get into blues. It's a little improvisational and ragtime. But to actually play symphony level piano, this is how your brain works. The rest of us are just
my problem is I don't know how to talk to people.
Trying to find
I spent 25 years talking to a guy using Greek letters, and we could have this whole conversation in a minute, and I got to decompress it.
You have to deconstruct it, and then we have to, build it back up in simpler, layman's terms. But it is you are, again, symphony level, and the guy
was there anyone that was
okay? Russian bot is not even at chopsticks, so don't
no. But the point is that it was the first time I felt comfortable articulating. Like, my partner is different than me. He's the greatest trader ever. He's a little emotional. He wishes he was somewhat autistic so he could be a better trader, but he's such a good person with no ego. Okay.
Love that.
But he says, you've got to watch sometimes telling people the full truth because they get scared. And I say, the people that are going to get scared that I don't have credibility with, I'll never get it. But I need to get myself on the record of what my view is, because if I'm not, when it happens, I don't get credit for seeing the 90% draw like it was a 5% draw.
This is correct, but I have to tell you something. You do a lot of spaces now to get the word out and to improve your voice. But it would be also, and your Twitter feed obviously is growing. But the point is, these succinct summations of market direction and or reasons. Now, you used to write in code, right? So when we started engaging, I was like, what the heck? Would you translate that? Now you actually do a much better job of clarifying for the uninitiated. But my point was this: you really have got a full thesis in your head worked out. Have you really worked out the timing?
The timing is dependent. I know the target. Okay. I know that interest rates are going to be at zero within 18 months. I know the NASDAQ is going to be down 90% within 24 months. The longer they make you wait, the faster it falls. There is no solution to getting the system stable without negative interest rates. There isn't.
You just said 18 months, and honestly, my eyes glazed over, and you can't see them. You
or
said
less.
Or less. Obviously, the rate of change matters. For a 90% drawdown.
No, the drawdown could take 24 months, but the interest rates go to zero in 18 months. The problem. So going back to Y2K, this is what happened. Greenspan wanted Gore, so he hikes 25 February 2. He hikes 25 March 21. The market peaks 3 days later. The NASDAQ starts a draw. We get a 9-month, 9,700 basis point expansion of XLP versus QQQ. You got 81, 81. It could be 80. I maybe got the number 81 or 86 on the XLU. XLV lagged, which could be just related to that time frame because of biotech. And then NASDAQ went down further. XLU, VNP, XLP and U stopped going up. XLV did go up a little, but then after about 3 months, the collapse of equity returns raised equity risk premium, and then the only thing that was rising in price were treasuries. Stocks were getting slaughtered, everything, including utilities, which fell 50%. So What's happening is you've got the liquidity. It's getting into a smaller universe, pushing things up kind of like a jet engine. But Greenspan stepped in after the market peaked. 7 weeks later, so it peaks on March 24, he hikes not 25. He goes nonlinear. He goes plus 50 to 6.5 on March 16th. Excuse me, on May 16th. 3.5 months later, the S&P goes all the way back to the high. So using the SPY, it's 153 and change. We went back to 153 because those hikes. Okay. Then what happens? We go down 80% in 25 months in the NASDAQ. We're worse than that. Money's faster. There's less liquidity. We have a lower rate structure.
When you say there's less liquidity, you talking about supply of the mortgage?
No, when I say less liquidity, the banking system is a freaking disaster.
Okay. But we have 3 trillion in extra, money.
That's not money going into risk. That money is only going into sovereigns, which makes it worse. You're pushing up the short. You're creating liquidity deflation. When the short goes up, you lose.
All right. So
when the rebate rises, aren't you losing equity?
Hold on. Rebate rising. Remind me again how you use the term
UMBS, XLU, XLP, they were the source of funds to buy stuff on margin. That's what was sold and rebated into. You sell something and you rebate that money into your long. Your treasuries, your mortgages, your XLU, XLV, XLP, because people are chasing return. They're diverting money from S&P to growth, which means less liquidity going into value. And then the slower upside momentum, because they only earn 5%. They can't buy in their own stock. So then you get the algos and you get the hedge funds shorting them because there's no momentum. They're shorting the calls. They're shorting the skew. They're shorting the stocks. And they use all of those proceeds to buy FANG, which went up 190% from November 9 to July 10. So all the rebates, the things that you short, when they rise, that takes away liquidity just as much as FANG going down. When your liability goes against you, you lose just as much equity as when your asset declines. Isn't that right? $1 of loss is $1 of loss, whether it came from your long or from your short. It's a pincer. You're getting it from both. And the Fed stops things. Look, we were at 366, 367, 368. We're at 373 on the 10-year. They do not want these rates going lower because that's going to create the margins. That's going to create 2.0 margin call 2.0.
Yep. No, I'm watching it. Also intraday, it's definitely putting in a bottom formation, and yet the stocks will follow.
But it's because of policy.
Yes, but the policy.
Goolsby's out there trying to say we don't really have to go 50.
Yes. Okay. So, but at the same time, Waller was like, well, maybe we'll be down. But the point is, I hear you. I hear you. This is the telegraphing of.
They do not want the rebates to rise. And when treasuries rise, Staples Healthcare and utilities will rise. When treasuries rise, mortgage rates will fall. And then they'll be suffering with even more money that they have to put to work because of all the refinancing.
Okay, so then I hate to even ask, since we covered pretty much.
Why do you have to ask? I mean, why do you have to hate it? Just ask.
Gold.
Is gold in the long portfolio or the short portfolio?
Oh, very much long.
And is it the last man standing? Yeah, it's the strongest.
Correct. That's why I'm asking.
Okay, but what happened in Reagan 2? What happened in Bush 2 when oil cracked? They lost so much. They had so much liquidity deflation at CTA long only unlevered with no gate. They had to dump the paper to make the redemptions. So they sell their oil, they sell everything. It's in the long basket.
I always call gold the collateral trade. Just because I know sometimes.
Yeah, but sometimes your collateral decays, and sometimes you got to come up with more collateral. If oil is going to go down from 70 to 40 or from 80 to 40, do you have any idea what 2.1 trillion versus only 6%? Gold is 6% of oil. Okay, in terms of annual trade. Oil breaks down. It's taken inflation down with it. It's going to strengthen the dollar.
So you're not worried about the dollar rising and deflating gold. You're actually saying gold is going to
No, it's all of these things. It's all of these things. The gold is going to put the dollar up.
Yes, that's what I mean.
People are short the dollar to buy gold.
Yes, that's my point is you're
But
saying.
it's the same trade.
Yes,
You know,
I
it's like
understand
buying a put to sell your same call. It's crazy.
Does it matter?
Excuse me. They just reported 627 on the mortgage. Okay. We're one day next week they could print 599 mortgages. Do you know what that's going to do to people?
It's going to cause the 10-year to absolutely take out the 3.66.
Well, but then what's that going to do to mortgages? It's going to push those yields even lower. And then what's that going to do?
Wait a minute. So how is this going to happen with FOMC a week and 2 days away? Like,
who cares? It's too close for them to do an emergency meeting.
No,
they
but
can't
my
do
point is, you still don't think they're going to go 50?
How can they?
Huh.
How can they let the treasuries go up in price? How can they let the mortgage go up in price? They'll kill the shorts.
Okay. Well,
if they let these go up in price, then you get more refi, then you get more curve inversion, and then that's how you blow up Citigroup. Citigroup blows up from inversion more than they. What is a bank? A bank is four things. They're BDCC. They're a broker dealer, curve and credit. Okay, they make fees, proprietary or whatever. They make credit, whatever, but they make on cheap and steep, and they try to lend to their garbage customers so that they don't have to self-fund and draw down their inventory and fire all their labor, and then kill average hourly earnings growth, and then kill inflation, and then make real rates go up and the dollar go up, and then imports come in, and then you lose more labor. I mean, it's all the same thing. It's all a disaster. So it's like that's what happens when they do everything everywhere all at once. The algorithms diffuse risk across everything with risklets. You, me, and a rabbit, we're all the same DNA. There's a little change, 1%.
Okay, I don't know how your mind works there, but
risk is risk.
Okay, I get it.
Listen to that guy. Come on, and then Rogoff. Rogoff is an embarrassment. He's Larry Summers with gray hair. These guys don't know anything. And the guy was couching everything. I couldn't even read it. It was an embarrassment. I mean, my partner's last name is Rogerson, you know. So,
but to get my point, everybody is on that a higher for longer theme. So at some point
they're in the 80s, and I'm in ZERP. It couldn't have been within 1 second of you reading anything I wrote not to know I'm a ZERPer. It used to be in the tweets. What?
I know that you're a ZERPer.
So nobody in the world's a ZERPer, and they will all be ZERPers when we take out 252.
Okay, so where does the dollar enter in? Only at the end in a panic?
No. If they go linear, and then we get lower rates and faster selling, then we get more losses, right? As rates go low, do you accept that lower rates are bad for stocks?
I do, yes.
A lot of times lower rates are good for stocks, but not
no. But we turned. I turned that upside down in April.
Okay.
That was a huge change for me. You have no idea.
Lower rates produce more liquidity that can only go into sovereigns. You don't take refi money and put it into stock. You put it into a mortgage or a treasury because of regulatory requirements. Okay. Then you start widening your credit because remember, the curve is melting down, right? By the way, the square root of -1, I don't want to go into that, but what's on the other side of the end of the universe? You know, we had the Big Bang 15 billion years ago. Okay. And we're looking at light, you know, the furthest part of the universe, the microwave stuff. You're looking at something that's 15 billion years old that came back to us. What's on the other side of that? Okay, so no one really knows. Okay, what yields less than treasuries that are the lowest yield? It's a vacuum. And that's why it's going lower. There's nothing there. So you get lower rates, nobody's borrowing, you're getting flooded with all that liquidity. When we're what 200% refi, you know what that's gonna, can you imagine 200% refi? How crazy is that? We were 118, now we're 94. What is that going to do to the system? Banks were invented in a world before digital. Silicon Valley Bank couldn't survive digital. Citibank can't survive digital. They can't. The inversion is digital. You know, these people say Yellen should have extended the duration. What are you talking about? There's swaps. There's no such thing as telling duration. You could sell all you want on the 30, they'll swap it out. They'll swap it out to the 2-year, and then you'll have some riskers take that curve risk. There's no such thing as moving rates up. It's an insanity. We've been falling since 82.
We've been falling for it since 82 because it has worked. But then
and we had a little
COVID.
bubble because
Yes,
Powell
yes.
jacked up rates like a lunatic. And
Well,
now he can't do it anymore. And it's going back to where it was. It's trend.
so I
This
get
happened in 80. This happened with Volcker in 84.
but
We
there are things
violated the
called,
channel.
but
What?
there are things called trend reversals after a 40-year.
But this is not one of them because it's not systemic. It's policy, and policy is pathetic. Okay.
I want to ask you about final kind of points on the dollar. We did talk about collateral and such.
Oh, so when the stock market goes down faster, the risk departments will tap them on the shoulder and say, cut down your risk. When you're in the US and you buy a tech stock, it's considered less risky than a tech stock in Europe because they have currency exposure. So they give you a risk weighting. So they're going to want to keep their positions. So they'll cut off all their international exposure. And then they got to convert their euros and their yen back into dollar. And that's your dollar bid. It's just the delevering of leverage. It's a mechanical thing.
Okay.
When you're low.
But it's also a major headwind to the equity.
It's worse than that because then it kills oil and then it kills data dependency and then it brings rates. I mean, it's all one thing. It's the diffusion of
when or what triggers the dollar higher and time frame? Best guess. Did I leave you?
So I'm telling you what I'm doing right now. Okay. I'm psychologically preparing to cut my friend's risk in half from October 2nd to October 9th, because I think there may be a conference call and an emergency ease on October 9th and between October 2nd and October 9th. Because they cannot do linear or the market will collapse before the election.
Okay, define linear again.
25, 25, 25, 25, or 50, 50, 50, 50. The market can prepare for it and then just use the futures contracts to fund the leverage that they're going to put on more cheaply. Okay. If they go 25, 50, 75, you can't trade an arc. You can't position an arc because you don't know if it's going to go 25, 50, 75, 100, 150. You need linearity. That's what happened in 2022. They went 25, 50, 75, 75. They still thought it could go to 100, but once they did the third 75, that was it. And we bottomed on 3 hours after the minutes were released at 2:00 on October 12th. The S&P bottomed at 10:30 in the morning.
You're talking 2022?
2022. And then FANG bottomed 5 days after the 75 cut, which was the last one. They bottomed on November 9th. And the last 75 was November 2nd. And we did our tweet maximum long CKY on October 28th, I think 7 or 8 trading days before the actual low, because it was inevitable that once the S&P stopped going down, there'd be too much creation of liquidity. So too much, what do you call it? Liquidity deflation. There'd be too much liquidity inflation from the rise of S&P and QQQ that they couldn't sustain the selling pressure in FANG. And that was actually the low 5 trading days after November 2nd, and we put it out. I guess it might have been the weekend, so it was 5 trading days from the meeting, which I guess was a Thursday, so it was 7 trading days before. But when you get the liquidity in the S&P and the Q, you couldn't sustain the down trade in the FANG. Similarly, you couldn't get a good, healthy bear market without the semis leading FANG, leading the. It's got to be in the proper order. You can't get a good bull market in the bond until the bond is leading the story. So the bond is the equivalent of the semi. Kathy Woods is a whole different story. She's a nonsense. But semis have to lead FANG lower, and that then leads the Qs lower. That leads the semis lower. Excuse me. That then leads the S&P lower, and then that pushes yields and mortgage rates lower. Just it's a vicious cycle. There's no way to stop it. The only way to stop it is rate hikes or nonlinear cuts to stop the rally. So by raising the cost of money, you delever the system and do nonlinear cuts. You extend duration, and then the other side of that is in some inflation expectations temporarily, but it's very, very brief. No, we're in full collapse mode. You can get some sliding time for weeks, a month, but it's all about a calendar day. November 5th, we got 50 trading days.